Welcome back to Indianomics. We have been asking a very important question that seems to be coming to the center of the India growth story. Is the Indian rupee getting too strong for India's own good? I've been speaking with Sonal Verma of Nomura, Deepali Bhargava of Credit Suisse and Anant Narayan of Standard Chartered. Anant, now to the view forward. Do you think the rupee can get even stronger? What is the stand C view? I mean, there are people who are even talking of 58.
We're not that radical, Lata, as yet, though who knows, even the radical view might come true. We still think that rupee will remain largely stable. That's the official view at about the 64 mark. Look, there are a few factors at play here. One is the dollar continues to weaken. In fact, we started the beginning of the year expecting the dollar to strengthen and continue to strengthen. That clearly has belied hopes. So from a 103, dollar index, we've come down to about 93. It's almost a 10% move which has happened. And it's possible that dollar could continue to soften in the global markets. Now, if that happens, you would have reason for dollar rupee to remain soft and continue with the current trend of remaining soft or remaining stable. The other issue which remains is that, the old point about the impossible trinity, the fact that you have an independent monetary policy, which is inflation targeting, does leave the market with the perception that maybe real rates in India are a bit on the higher side, because of which interest rate differentials are high, which has an impact on capital flows as well as on the stability of the rupee. One of the reasons why exporters are hedging so much is they perceive the forward premium, which is nothing but interest rate differentials, to be on the higher side compared to what they expect the depreciation to be. So given that, you might see the trend continuing. What I'm worried about, though, Lata, is I still believe that a big part of this particular rupee appreciation story that we've seen so far is on the back of an increase in unhedged exposures and a substantial increase in unhedged exposures, which means that the possibility of a backlash and of a reversal, if you have a global risk-off, is quite high. And in today's markets where traded volatility might be pretty low, but uncertainty still remains extremely high, and it's only a tweet away, from one more risk event. It's not a good situation to be in. In fact, what we would recommend to our clients is to actually be cautious, take advantage of the fact that markets are very favorable, dollar rupee is low, volatility is low, premiums have come down, and buy insurance. While the base case is not, we don't expect 67, 70 to happen in dollar rupee over the next 1 year. Who knows? Vulnerabilities are there. Buy the insurance, participate on the downside if dollar rupee comes down, but be prepared in case you see a spike up in dollar rupee because of global or domestic events. So that's the broad sense that we have as a bank, at least.
No, that's the advice to the client, but I'll come back for what you may have for policymakers. Let me get Sonal and Deepali as well on this. Sonal, how do you think the rupee is headed for the rest of the year? And how would you want policies to be designed to prevent the rupee appreciation from harming growth?
Our view, more from a 6 to 12 month time frame, is we are positive on the Indian rupee vis-a-vis the US dollar for all the reasons that are very well known, including number of pull factors for India, good growth, good reforms, FDI, which is funding the current account deficit. So we are looking for INR to appreciate marginally from current levels to about 63.8 by the end of this year, and we actually have a more longer-term forecast of about 62 against the US dollar by 2019. Conversely, we are more cautious on the outlook for China. Growth has been stable, but we see growth slowing again after the political transition later this year. Financial debt remains very high, and we think fundamentally the pressure in China continues in the direction of capital outflows rather than capital inflows. So we do expect the Chinese yuan to actually depreciate against the US dollar. So from that perspective, and getting back to your earlier question, Lata, I think from a bilateral exchange rate perspective, the pressure on INR will be fundamentally in the direction of appreciation. and we really need to sit down and think in terms of how and what should be the policy strategy to deal with the appreciation pressures that we see. And if I may, just put in, the question is what should be the approach on the policy front, one is we need to prioritize capital flows. So, equity more than debt, long-term more than short-term. Second is, continue to intervene to build FX reserves, sterilize the liquidity that is created as a byproduct of that. And third, allow a bit of, appreciation.
Well, my only point is that much of this we're already doing. I mean, prioritizing equity over debt, we've already done. We already have limits on all kinds of debt. Okay, yes, sterilizing liquidity is the issue, and it's already marching to the stock markets because of abundance in the interbank market, and that's creating its own froth. Deepali, how are you looking at the course of the rupee vis-a-vis other emerging markets? And as well, are there really so many policy choices? If you have an MPC with a given mandate of inflation control and you have a crude which looks, on a secular term, headed under 50 or around $50.
India carry and stability still are pretty attractive for investors. So we have a pretty bullish INR view of about 60 to 50 on a 12-month horizon. I think RBI was probably looking at RMB very actively for the last 3 to 4 years, but I think how the USD trades broadly will be very important as to in terms of how RBI manages the INR from here on. And our G10 strategists have just held their 3-month Euro USD view at 1.19, and Euro is actually run ahead run ahead of all the measures. So we are pretty bearish on US dollar like the others, and hence have a bullish view on INR more from that perspective. I think one way they could really ease the valuation constraint that India, I think, will face is by running a consistently lower inflation than its trading partners, and that'll probably be something which the Monetary Policy Committee can focus on, for the next few years, get macro stability, inflation stability in place, and that in a big way can take care of your, INR overvaluation concerns.
Anant, you have spoken more about financial vulnerability. We have discussed economic vulnerability with the economists. How can RBI or the policymakers tackle the potential financial vulnerability from unhedged exposures?
Well, a couple of ideas, Lata. One, to be honest, the RBI has already been a pioneer in applying macroprudential norms to control unhedged exposures. And this was kind of a unique experiment in India where, the RWA that banks assign to clients who don't hedge actually goes up. It's been a matter of a lot of debate, but I do see a merit in that. I do see the use of macroprudential norms as being one way in which we control this particular vulnerability. The second thing, which is a little more tactical and market-linked, one way in which RBI has been sterilizing this the excess liquidity which comes out of spot purchases is by actually buying dollars in the forward market. When they buy in the forward market, obviously the liquidity in the spot market doesn't come in for rupee. But concomitantly, what also comes about is there's a bit of a support which comes in for forward premia in the FX markets. Now, India is not a country with perfect interest rate parity. So your implied forward premia and implied interest rate differentials can be very different in the FX markets compared to the money markets. Okay. Now, one suggestion is that the RBI should maybe stay away from the FX intervention in the forward market, therefore allow forwards to find their own natural level of demand and supply to a level where it comes down, where exporters think twice before they hedge, and importers are enticed to come in and start hedging more. Okay. Now, clearly RBI is aware of these dynamics, and it chooses between OMOs, MSS, and other reverse repo, etc., vis-a-vis the FX forward markets. I do think staying away from the FX forward markets would be a good option to allow a semblance of natural stability and balance to come in the FX markets. Last bit, Lata, on this whole economic fundamental situation, we can only give anecdotal evidence. I can think of several clients who are facing the pressure of import substitution, or at any rate are being asked by retail houses, by other clients to reduce their prices, citing that imports from China, Vietnam, etc. are becoming cheaper.
So we are not going away from the problem of rupee appreciation anytime soon. And with it will come the issue of trying to make domestic manufacturing as attractive or more attractive than imported goods on other parameters. So ease of doing business, encouraging Indian macros to remain stable. All these cannot be achieved in a day, but that's the effort. And as very importantly, Anand points out, to keep the eye open on vulnerabilities in the financial market because of unhedged exposures of importers in particular. Well, that's a lot of task, and it's a sobering thought that the rupee strength, first of all, is not very good for the economy, and secondly, that the problem is not going away anytime soon. Thank you very much for watching this edition of Indianomics.